One of the best forms of true passive income is to invest into dividend-paying stocks and ETFs, and generate income on a quarterly or monthly basis by just being an owner of this asset. But what about for investors that might not have as much money to invest in these sort of assets? Well, let's take $10,000, invest it into dividend-paying stocks. With this amount of money, it might not seem like it could generate any sort of decent amount of dividend income, due to the fact that most dividend-paying stocks and or ETFs offer nothing more than a starting dividend yield anywhere from around 2 to maybe 10% at most on average. But in this video, I'm going to share multiple different methods on how an investor could in theory invest $10,000 into higher yielding instruments and potentially generate significantly more income than they would if they invested into more of the traditional methods. Now, although these methods might be a bit more risky, you know what they always say, more risk, more reward. So stick around, drop a like in this video, and subscribe if you're ready to dig into it. Now, just to be clear, taking something like the SPY, the S&P 500 ETF Trust, and looking at the dividend yield for this ETF, it pays around a 1.45% trailing 12-month dividend yield, or around $6.52 on a yearly basis. Now, an average investor out there, say someone that has just around $10,000 to invest, they would in theory only be able to buy around 21 shares or so of this, which means that they would be earning around $120, $140 a year in dividends. Which of course isn't all that bad considering an ETF like this does have a ton of growth potential. But for the sake of this video, we're talking about dividend income and trying to find different ways on how investors with a relatively small portfolio can generate the most amount of cash paid from dividends on a monthly, quarterly, and yearly basis. Which brings me right into the first option. This right here, ticker symbol SVOL, the Simplified Volatility Premium ETF. Now this is an ETF that actually shorts the volatility index, the VIX index. And by using this strategy and doing so, this ETF has generated a boatload of dividend income so far, at least historically. The trailing 12-month dividend yield, for example, for SVOL is 16.53%, with a trailing payout of around $3.83, and this is from a $23 ETF. So heading over to the calculator, if an investor was to invest $10,000 into this one specific ETF, for example, you would take $10,000 divided by $23 per share, which means an investor would in theory be able to buy around 434 shares of SVOL. Now, because of the Simplified Volatility Premium ETF strategy, the ETF is going to pay a different amount, most likely on an ongoing basis, but some of the previous months pay anywhere from around 32 cents per share, down as far as recently to around 30 cents per share. So if we were to take the 434 shares that an investor could buy, which is $10,000, multiply it by 31 cents, which is how much in dividends on average around an investor is receiving from investing into this ETF. An investor could receive around $134 or $135 a month in dividend income if they were to invest into something like SVOL. Now, another sort of alternative investment strategy for an investor to generate a massive amount of income on a monthly basis, if that's what they're looking for, with just $10,000, for example, is to invest into something like the YieldMax Tesla Option Income Strategy ETF, known as ticker symbol TSLY. Now, this ETF has a pretty interesting strategy as well. They use options and write synthetic cover calls on the underlying stock Tesla. The YieldMax team is able to generate a massive amount of dividends on a monthly basis. So I know what you're probably asking next, how in the world do these covered call ETFs from YieldMax even work? And how are they able to generate such massive distributions for investors? Well, first of all, let's go over some of the basics of a covered call strategy. For those that might not be aware of it, covered calls involve buying shares of a stock and then writing call option contracts on some of those shares. A covered call could also be referred to as call writing or writing a call option on a security. And for beginners out there, it's going to be a little bit confusing because there are different terminology and different ways to say the same thing. For example, if you want to sell a covered call, you could also say that I'm looking to sell an option. There's many different ways to say it, but they all pretty much mean the same thing. So other investors can then purchase the call option that the sellers are of course selling to them. Now, for the contract buyers, they pay a small fee, or in the case of Tesla, Apple, and some of these names that YieldMax uses, sometimes a larger fee to the call writer, known as the premium for doing so. Now, the contract gives the buyer of the option the right, but not the obligation to buy shares at a specific price on or before a specified date. In the case of call options, when the share price of the underlying security rises above the strike price that is agreed upon, an option holder can choose to exercise the option, at which point the stock could be called away from the person who wrote the call option or that sold the call option. Now, to give you an idea, TSLY has a trailing 12-month dividend yield of around 50%, and has paid out over the last 12 months around $7.36, and this is for a $14, $15 ETF. Now looking at the previous payouts, it's going to change a lot considering the strategy involved, very similar to that of SVOL, meaning that because of the strategy, it's not going to pay the same amount of dividends most likely on an ongoing basis per month. But as you can see, even if you take the lowest payouts and try to average them out with some of the highest payouts from like 44 cents up to $1, even if you were to average out the dividend payout around 60, 70 cents per share, $10,000 invested into that ETF would purchase around 689 shares. So if we were to multiply that by 65 cents, which is sort of somewhere around the average of what it's paid per share per month, an investor in theory could receive around almost $450 per month by investing just $10,000 into this Tesla option income strategy ETF. Now the last ETF that could potentially generate a massive amount of income for investors that don't have all that much to work with is going to be SPYI, or the NEOS S&P 500 High Income ETF. Now this ETF is relatively new and it has a pretty straightforward strategy. It says the fund seeks to distribute high monthly income generated from investing into the constituents of the S&P 500 index and implementing a data-driven call option strategy. Now, a side note, the cool thing about SPYI, for example, and why I've been buying a lot of shares of it as of recently, is that it's pretty tax efficient, at least it's hoping to be, and also because of the cover call strategy and the sort of lack of upside potential historically with that strategy, this ETF also buys a small amount of call options just to try to capture some of the upside potential as well. Now, SPYI has a pretty massive trailing 12-month dividend yield of around 11.61%, and it's paid out around $5.76 over the last year or so. Now looking at SPYI, it actually has paid out a very consistent amount on a monthly basis over the last year or so, which is definitely nice considering some of these covered call ETFs don't necessarily do that. Now if we were to take $10,000 and invest it into SPYI, we could buy around 204 shares of it. Now because SPYI does pay around 50 cents per share per month, or at least it has historically speaking, an investor could earn around $102 on a monthly basis if they were to want to invest into something like this ETF. Now just because we went over multiple different examples of ETFs that do pay higher than average dividends on a monthly basis or so, it doesn't necessarily mean that those are the best ETFs to buy into, and it doesn't necessarily mean that those are the ETFs that are going to make investors the most amount of money long term. You see, there's other dividend growth ETFs out there like the Schwab US Dividend Equity ETF, for example, that has a smaller starting dividend yield of around 3.5%, but offers things like massive dividend growth. Which means that even if the ETF isn't paying a massive amount of dividends today or tomorrow, at least historically speaking, it has consistently been paying more and more in dividends as times went on. Which means that, for example, if you would have invested into something like the SCHD ETF 10 years ago, you're receiving just around 22 or 25 cents on a quarterly basis from this ETF. But if you were to fast forward around 10 years or so, you are now getting paid around almost 3 times as much by just holding on to your initial investment. Now that's definitely something to keep in mind and maybe be concerned about if you are an investor out there that wants some dividend growth, that wants some raises in your overall dividend income in the future. Because looking at something like SPYI, it's paid out the same amount more or less since the fund's inception, which I'm not saying is bad at all. But with an ETF like this, you're not necessarily going to be expecting the amount of dividend growth that you could see from something like SCHD. But there we have it. Those are 3 different methods on how an investor with a relatively small amount of money invested, say $10,000, could generate a massive amount of dividend income on a monthly basis. Now, once again, I'm not saying that investors should by any means chase high yields or of course chase income, but the cool thing is when it comes to the stock market, there's really something for everyone. Whether you want to invest in something with much more growth potential, or if you want to buy into an ETF with a massive high starting dividend yield. When it comes down to it, there's really an ETF or a stock out there for everyone. But out of all 3 ETFs we went through in this video, if you could only hold on to one of them, which one would you choose and why? Comment down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.